Good evening, everyone. We are Group D, and we'll be presenting a financial overview review. My name is Megan.
This is Jodi.
This is Branon.
Hi, this is Anita.
And my name's Pete Charboneau.
And I'm going to start us off with an overview on the first section we're going to discuss is finance and the firm and how finances can impact firms. So one of the main aspects of firms that determine the finances overall is the firm size. Given that there are different limitations and needs of all different firms. So I've listed a couple of main aspects that can affect the firm size as well. So production technologies, capital intensities, and scale economies as well. All of those play and contribute into the overall firm size and impact the finances as a result of that. There are four main financial objectives of every organization. The first one is profit maximization objective, and this stems from the early economic theory where the profit of the firm was the entire income for the owner of the firm, and the owner and the firm itself were very synonymous. The maximization of the profit actually ensured the self-interest of the owner, and the competition at the time was also reinforced profit maximization, given that any cost increase could be a result of an environmental shift. The next one is wealth maximization objective. And the idea behind wealth maximization objective is maximizing the net present value or the wealth of any course of action. So this is the difference between the present value of its benefits minus its costs. All actions that the firm decides to take have a financial value, and if the action results in a negative net present value, the action should be rejected. So we obviously want to maximize the wealth for every action. The third financial objective is value maximization objective, and it leans back on shareholders of a company. So the owners are the equity shareholders of a company, and all firms want to maximize their present wealth. And so the wealth of the shareholders is represented in market value of the equity shares, which the firm, obviously, like we mentioned, wants to maximize. They want to maximize their equity shares. And the market price of a share shows the overall performance value of the company. And then finally, the other maximization objectives, there are a couple ones that I'll just quickly run through. Sales max, so sales revenue brings benefits of growth, and they can bring market share and status. So sales maximization is another objective. Growth maximization, concerned with the market values such as like profit, sales, and market share. And then ROI, or return on investment, it must be a long-term and satisfactory and favorable for the firm itself. Next. So we're going to run through some financial markets, and we're also going to talk about interest rates. So for financial markets, they all stem from and have origins of capitalist economies. And so capitalism is a main building block for financial markets. And by allocating different resources and creating liquidity for businesses, buyers and sellers can trade holdings. These holdings are called security tradings. And the trading of securities, you can either get this one of two ways. So they provide returns for those who have excess funds, and they also, for those who are running low on money, provide additional cash. And I've listed a couple there: equities, bonds, currencies, and derivatives. Those are all examples of trading securities. And then interest rates, you have a couple of main interest rates to think about and just some aspects of interest rates. So the first one is very well known, annual percentage rate, APR. And this is when the lender charges for the use of assets, and it may be represented in the form of cash or consumer goods or large assets. It doesn't just directly have to be monetary value. And then you also have risk, and risk plays a very important role in interest rates. So situations with higher risk or higher interest rates most likely are riskier investments. APY is the annual percentage yield, or it's essentially the real rate of return earned on savings, deposits, or investments. And it's usually with compounding interest. And so compounding interest is this idea that every additional charge of interest is added to the sum of the loan, and that just carries over continually. And usually this is immediately added to the balance, and it's calculated periodically as well. Next. And the last thing I'm going to review is just a bunch of different types of financial institutions. So the first one, it's pretty well known. It's a central bank. And this is responsible for oversight and management of all of their banks. And this is essentially the Federal Reserve, as we know it in the US. And it conducts monetary policy and supervises all the financial institutions that we have. It works directly, usually with businesses and not with consumers. The next one is retail and commercial banks. And this can provide products to consumers. It can also offer deposit accounts, personal loans, credit card. They can also work with businesses, but they are more geared towards consumers. The next one is internet banks. So they're very similar to retail banks, except it's an online platform. There's no physical location. Credit unions are the next, and these target, very similar to retail as well, they target specific demographics for their membership, and all of the credit union is actually owned and operated by the members themselves for their own benefit. The next one is savings and loan associations. So these can be a wide variety, but essentially deposit accounts, personal loans, mortgage lending, and the business provides no more than 20% of total lending to all businesses. Investment banks and companies, they do not take deposits, and they help individuals, businesses, and governments through security trading. Then brokerage firms, similar in the security trading, this is essentially the buying and selling of securities among investors. Insurance companies, everyone is very familiar with insurance companies. They transfer risk, the risk of loss, and put monetary value on risk, and basically protect against financial loss due to a huge number of tragedies that could happen, whether that's to assets or to yourself. And then finally, mortgage companies, very self-explanatory. They mortgage loans that either serve the individual consumer market or commercial real estate, and it just depends on the financial institution. So next, Jodi is going to lead us in an accounting review.
Good evening, and I'm going to do an accounting review. Accounting plays an important role in a firm's financial success. Accountants prepare financial statements that are used to analyze the condition of a firm and to plan the future. Financial managers that know how to use financial statements can create real value for a firm's owners. All public corporations must follow certain accounting guidelines known as generally accepted accounting principles, or GAAP. These standards ensure that all companies are reporting financial statements in the same manner. The Financial Accounting Standards Board, or FASB, is a private professional accounting body that publishes the rules that GAAP uses. Organizations must also, that are publicly traded, must adhere to the Security and Exchange Commission, the SEC, by reporting audited or unaudited statements that are regulated by the SEC. And one other thing to mention in the accounting review is the basic accounting equation, which is assets equal liabilities plus equity. Your assets are the items that the business owns, your liabilities are claims on the business by non-owners, and equity are claims on business by the owners. Good evening, and I'm going to do an accounting review. Accounting plays an important role in a firm's financial success. Accountants prepare financial statements that are used to analyze the condition of a firm and to plan the future. Financial managers that know how to use financial statements can create real value for a firm's owners. All public corporations must follow certain accounting guidelines known as generally accepted accounting principles, or GAAP. These standards ensure that all companies are reporting financial statements in the same manner. The Financial Accounting Standards Board, or FASB, is a private professional accounting body that publishes the rules that GAAP uses. Organizations must also, that are publicly traded, must adhere to the Security and Exchange Commission, the SEC, by reporting audited or unaudited statements that are regulated by the SEC. And one other thing to mention in the accounting review is the basic accounting equation, which is assets equal liabilities plus equity. Your assets are the items that the business owns, your liabilities are claims on the business by non-owners, and equity are claims on business by the owners. Next. To get a picture of how business is doing, a business will create the financial statements. The three financial statements we're going to discuss are income statement, balance sheet, and the statement of cash flows. So first, the income statement. This is actually Apple's 2019 sorry, let me start that over.
Okay, no problem. Hang on, let me. Yeah, you don't really have to stop the recording. I'm at 9 minutes. Can somebody just take a note that we're starting over at 9 minutes?
Okay. So the first financial statement we'll look at is the income statement. This is actually Apple's 2018 income statement. They call it their consolidated statement of operations. These statements show revenue, expenses, and income of a company. The revenues would be your gross income, usually from sales. Your expenses will be divided down into your cost of goods sold, which are expenses that relate directly to the sale of your products or services. And then you have selling and administrative cost and depreciation. And you take your expenses from your income and you get your net income, and from that you can calculate your earnings per share, which is your net income divided by number of shares of outstanding stock. Next is our equities section, which has our preferred and common stock and our additional paid-in capital. Next is our statement of cash flows. This shows how cash flows in and out of a company over a given period of time. And this is done by looking at operating, investing, and financing activities. Your operating activities include any sources and uses of cash from business activities, or how much cash is generated from the company's goods or services. The investing activities are in long-term securities or fixed assets. And then lastly, your financing activities are the activities related to the sales and retirement of bonds, notes, preferred and common stock, and other securities. Once those adjustments to those activities are done, you'll then have your net cash flows for the specified period of time. Next. Once we've created our financial statements, we're able to analyze the financial statements by the use of financial ratios. We have profitability, liquidity, debt, asset activity, and market value ratios. First ratios are the profitability ratios, which measure how much revenue is eaten up by expenses, how much is earned relative to sales, and how much is earned relative to the value of the firm's assets and equity. The first profitability ratio is the gross profit margin, and this measures how much profit remains out of each sales dollar after cost of goods sold is subtracted, and it's calculated by gross profit over sales. Next, we have our operating profit margin. This measures how much profit remains out of each sales dollar after all operating expenses are subtracted. Next is our return on assets. That indicates how much income each dollar of assets produces on average. Our return on equity measures the average return on the firm's capital contribution from its owners. And typically for these profitability margins, the higher the number is better, but you do need a benchmark for comparison. And a lot of the ratios are compared to other companies, to other periods of time from the organization or management's goals or targets. Next are liquidity ratios. And most of the time, we want our liquidity ratios to be greater than 1. That shows we're doing well. The current ratio compares all current assets with all current liabilities. The quick ratio is similar to the current ratio, but it's more vigorous. It excludes inventory from the current assets. Our debt ratio, typically if the debt ratio is higher, then it's determined riskier. Riskier is not always bad. It just means that the company may not have as much assets to cover that debt. Debt to total assets measures the percentage of the firm's assets that is financed with debt, and then the times interest earned is used to assess a firm's ability to service the interest on its debt with operating income from the current period. Next ratios are market value ratios. These are used to gauge the future prospects of how a company measures how much the investors are willing to pay for a claim to $1 of the earnings per share of the firm. The higher the price earnings ratio, the higher the investor's growth expectations. The market to book value is a proxy for the amount remaining per share after selling the firm's assets for their balance sheet values and paying debt owed to all creditors and preferred stock. Next are asset activity ratios. The average collection period is how many days on average the company's takes for their creditors to pay their accounts. Obviously, lower is better. You would need a benchmark to compare that to. The inventory turnover measures how effectively a firm converts inventory to sales. So a higher ratio equals inventory that sells well. The total asset turnover is how efficiently a firm utilizes its assets. A higher ratio means that assets help promote sales revenue. Next. In looking at ratios, we can also look at the relationships among ratios. The DuPont system was developed to do that, and it examines the relationships between net income relative to sales and the sales relative to total assets. And then there was also a modified DuPont system, which also measures the return on how the return on investment is affected by net profit margin, asset activity, and debt financing. Next. Once financial statements are created, for a company to be successful, business owners must be able to answer many questions, such as how much profit will the business make? How much demand will there be for our products? How much will it cost for our products to be developed and created? And how much money will we need to finance our operations? In order to answer the questions, business owners or financial managers must make projections about what they think the future will hold. There are different approaches that can be taken. Experience, probability, and correlation. Experience is just looking at what's happened in the past and using that to give us projected numbers. Probability, or things are just going to happen a certain way because the laws of probability indicate that's what they will be. Correlation can be used if there's a high correlation between the behavior of one item or account and the behavior of another account. And when you're creating pro forma financial statements, budgets can be used. So cash and capital budgets help determine what future values you think will be on the statements. Companies will choose a forecast basis. So when you're creating the pro forma statements for the future, things such as sales can be used by management specifying a target. Sales will be this amount next year. So that's what's used in the projected statements. A value can either be taken from your cash or capital budgets, as I just said, and The value can also be an extension of a past trend. Next. This is detailed instructions on creating pro forma financials for the income statement and balance sheet. Number one is using any special instructions on, well, it's number one on one and two on the other. So if there is a trend or there is a target number that management wants to use, those would be used first. And then going down through, you would use percentages and some of the ratios. You can read that at your leisure. And next is the time value of money. $1 in hand today is worth more than a promise of $1 tomorrow. The time value of money answers questions about how much money an investment will make over time and how much a firm must invest to earn an expected payoff later. To do that, we look at the future value of money. We have an equation: the future value of money equals the present value times 1 plus k to the nth power. Over to the right is how we do the equation. Well, we can do the reverse of that. If we know the present value of an investment, we can calculate what the future value will be. So those two equations are using like a yearly percentage rate. Now, if we wanted to calculate daily or monthly rates, there is a calculation here to do that. And then we also need to look at annuities, which is a series of equal cash flows spaced evenly over time. It's typically used in retirement. That is the equation for that is listed there. And then also a perpetuity is an annuity that goes on forever. There's an infinite number of payments, and that is calculated by present value equals payment over K. Next. So that concludes my accounting overview. Next, Branon will be talking about long-term financing.
Thanks, Jodi. I will begin the discussion on long-term finance decisions with an overview of the capital structure basics. A business invests in new plants and equipment to generate additional revenues and income, which is the basis for future growth. The funds raised from sources such as long-term debt and equity are referred to as capital, which are invested in long-lived assets to generate future cash flows. A firm can raise new capital from generating capital from the firm's operations, earnings belonging to the owner, and can be paid to them in the form of cash dividends or reinvested back into the firm in projects, for example, that will enhance the value of the firm and enhance the value of their equity. Therefore, funds from reinvested earnings represent capital from equity. However, a firm's operational earnings may not be sufficient to support all profitable investment opportunities. In this case, a firm is faced with the decision. A firm can raise new capital either by borrowing or selling additional ownership interests, or both. A combination of debt and equity used to finance a company's projects is referred to as its capital structure. The capital structure of a firm is some mix of debt, internally generated equity, and new equity. A common thought in finance is what blend of these financial sources is best for the firm, and answers the following questions. How much of the firm's assets should be financed by borrowing? How much should be borrowed by preferred stockholders? And how much should be financed by common stockholders? This question is important because each of these financing sources has a different cost and degree of risk. Therefore, the choice of financing directly affects a firm's weighted average cost of capital and the degree of risk to the firm. The next sector of my presentation, I will cover an aspect of long-term financing decisions that complement various financial needs of a business according to the type and size of business. Corporate bonds is a security that represents a promise by the issuing corporation to make certain payments to the owner of the bond. According to a certain schedule, the corporation that issues the bond is the debtor, and the investor who buys the bond is the creditor. Corporate bonds and the Partnerships that they create are detailed in the indenture, which is the contract between the issuing corporation and the bond's purchaser. The indenture spells out the various provisions of the bond issue, including the face value, coupon interest rate, interest payment dates, maturity dates, and so forth. Every key feature of the bond issue is spelled out in the bond indenture. I'll provide a list of the more innovative and new financial tools that have been developed in the bond market. Secured bonds is one, mortgage bonds, unsecured bonds, convertible bonds, junk bonds, as well as super long-term bonds. In the next sector, I'll provide an overview of preferred stock, its characteristics, and those who purchase it. Preferred stock is referenced in this manner because owners of preferred stock have a priority claim over common stockholders to the earnings and assets of a corporation. Preferred stockholders receive their dividends before common stockholders. Preferred stock is not issued by many corporations except in certain industries. The preferred stock dividend is usually prematurely fixed, so the potential return on investments for a preferred stock is not as high as it is for a common stockholder. Preferred stock is known as a hybrid security. It is a hybrid because it has both debt and equity characteristics. Preferred stock is like debt primarily because preferred stockholders do not have an ownership claim, nor do they have any claim on the residual income of the firm. Preferred stock is also like equity because it's, from my research, an infinite maturity and a lower priority claim against the organization than bondholders have. Preferred stock is created by a preferred stock contract and characterized by how the dividend is set. Preferred stock has a higher income and less volatility than the common stock, and greater liquidity than bonds. In the next segment, I will be covering leasing. Leasing is similar to a loan agreement for purchase of a capital asset on installments. The leaser's services are limited to financing the asset. The leasee pays all other costs, including insurance, taxes, etc. Leasing is regarded as essentially equivalent to a sale by the leaser. Therefore, leased assets must be capitalized and shown in the leasee's balance as a fixed asset with a corresponding non-current liability. The lessee acquires all the economic benefits and risk of ownership, but can claim only the interest portion of the lease payment as an expense. To be considered a capital lease, a lease must meet one or more of these following criteria. Title of the asset passes automatically from the leaser to the lessee at the end of the lease term. The lease contains a bargain purchase option under which the lessee may acquire the leased asset at less than its fair market value at the end of the lease term. The lease is for a period longer than 75% of the estimated economic life of the asset. The present value of the lease payment is greater than 90% of the fair market value of the asset at the beginning of the lease term. Financial leasing is a full payment lease because the lease payments pay back the full cost of the leased asset to the leaser with little and at times no dependence on the residual value of the asset. Next slide. In this segment of my presentation, I will discuss common stock and its correlation with long-term financing. A business's financial performance refers to any change in the business's financial condition over time. Common stock as a form of equity is related to both a business's financial state and its financial performance, and appears in different financial statements. Common stock as equity. Capital is a money source used to finance certain long-term capital needs. A business may issue common stock at any time during an accounting period. A business may also buy back a certain number of common stock shares at any time during an accounting period. A business may also reissue and repurchase common stock during subsequent accounting periods. Common stock owners can profit from the capital appreciation of the securities. Investors and management must become familiar with the role of the corporation and the basic means with which to finance the business in order to appreciate shareholder rights and privileges. Common stock equity financing does carry distinct risks that are applicable to owners and management. In the corporation sense, the limited liability status of corporations allows the business to raise capital by taking on debt and using common stock with relative ease. Common stock equity holders risk losing their entire investment shares, become worthless amidst business failures or bankruptcies, proceedings where bondholders arrive with superior claims related to the remaining assets. Management is always at risk for following laws as well as wishes, too much control over to a particular block of shareholders. The next and final sector in discussing long-term financing decisions is dividend policy. A dividend policy dictates how much cash is returned to shareholders when deciding what dividend to pay, if any. A company must look at the profits it has made, and weigh that up how much it should be retained in the business to fund future growth, and how much should be returned to investors. The dividend policy dictates how the value of the dividend is calculated and when it is paid. The dividend policy clarifies who gets what if a business has multiple share classes. Dividends and its policies form a significant part of a company's strategy and investment case. Paying dividends is treated as a sign that a business is financially healthy, although don't judge a company's financial strength solely based on dividends. Dividend policies provide a clear path for investors to follow and tells the market what to expect. Dividend policies help provide some clarity about shareholders' returns, but they should not be taken as gospel. Although many stocks try their utmost to deliver what they have promised, it is not uncommon for companies to rebase their dividend or abandon it altogether after years of hardships, which is no way to fund shareholder returns over the long term. In the next sector, Mrs. Anita will be covering short-term financial decisions.
Short-term financial management is basically the same as working capital management, so they're one and the same. So working capital is considered a firm's short-term assets, such as inventory, and its short-term liabilities, such as money owed to suppliers. So net working capital equals current assets minus current liabilities. That's the formula. So current assets can be cash and cash equivalents, marketable securities, accounts receivable, and inventories. Current liabilities can be accounts payable, expenses payable, and notes payable. So for net working capital, basically the definition means that cash will become available in the next 12 months and should exceed the cash that must be paid over the same period. So it should be positive in a healthy firm. So the questions to answer under short-term finance are: 1, what is a reasonable level of cash to keep on hand? 2, how much should the firm borrow in the short term? And 3, how much credit should be extended to its customers? Next slide. Short-term financial policy can be reflected in 2 ways. First, the size of the firm's investment in current assets, and second, the financing of the current assets. So the terms conservative or flexible and the terms aggressive or restrictive can be used. So first, flexible is a high ratio of current assets to sales. Restrictive is a low ratio of current asset to sales when it comes to the investment in current assets. So the financing of current assets, restrictive equals a high proportion of short-term debt to long-term financing, and flexible, less short-term debt and more long-term debt. So to give an example, flexible policy would have a large investment in current assets and would finance less short-term debt. And in addition, the net effect of flexible policy is a high level of working capital. With flexible policy, the firm maintains a higher level of liquidity. Next slide. Talking through cash management and liquidity, the intent is to keep cash investments as low as possible while keeping the firm operating efficiently and effectively. So there are reasons for holding cash: speculative, precautionary, and transaction-based. So speculative is holding the cash to take advantage of additional investment opportunities. Precautionary, holding as a safety margin. And transaction-based is the need to have cash on hand to pay bills. So the cost of holding cash in excess of the minimum incurs an opportunity cost. Basically, it provides liquidity to pay bills, but loses an opportunity for investments in interest income. Float management is controlling the collection and disbursement of cash. It involves speeding up collections, reducing customer bill paying time, and reducing the amount of time it takes for the cash to become available. Considering short-term securities characteristics, organizations look at four things: maturity risk, default risk, marketability, and taxes. So maturity risk is balancing the interest rate risk. Long-term has a greater risk than short-term, but has a greater expected return. Default risk, firms should avoid investments with significant default risk. Marketability, things that can be converted into cash quickly, like U.S. Treasury bills. And fourth, taxes, potential securities that avoid federal or state or local taxes, such as T-bills that are exempt from state taxation. And the next section on this slide is inventory management. So inventories represent a significant investment for any firm. Potentially 15 to 25% of an organization's assets can be held in inventory. It impacts both credit and inventory are used to drive sales, and they must be coordinated. And I will cover a bit about credit in the next slide. Inventory types are raw material, and again, raw material is wherever that process starts for an organization, as well as work in progress and finished goods. Inventory costs are considered carrying costs, so the cost to keep on hand, storage, insurance, losses, and the cost of capital, as well as shortage costs, inadequate inventory on hand, or stockouts. So inventory management techniques, I want to cover a couple. There's an ABC approach, which is where inventories are divided into multiple groups based on the understanding that the quantities of inventory and the dollar values of the inventory may have different relationships. So for example, a large number of units, but a smaller dollar value. In addition, there is the economic order quantity, the EOQ model. And this is where the number of units that a company is holding should add to inventory with each order to minimize the total cost of the inventory, such as holding costs, order costs, and shortage costs. So in essence, the EOQ model finds the quantity that minimizes the sum of these costs. Next slide. So credit and receivables. So if a firm decides to grant credit to allow a delay in payment, why would they do that? It's really to stimulate sales. However, it creates a receivable, and it also pushes the firm into taking on a liability that the customer won't pay, and also carries the cost of the receivable on the books. So some considerations or components when developing a credit policy are defining the terms of sale, determining credit analysis situations, and also collections parameters. In addition, you have to build a policy around the length of the credit period and the determination of, do you offer a cash discount, the discount to include prompt payment. And finally, analysis behind the factors that influence the decision to grant the credit will need to be done. So for example, an NPV analysis. So finally, short-term borrowing. There are unsecured and secured loans. So unsecured loans are non-committed lines of credit where a firm can borrow up to a specified limit without paperwork, like a credit card, or committed, which are more formal and legal. Compensating balances are another one, money that is kept by the firm with a bank in a low or no interest-bearing account as a part of a loan agreement. And finally, a letter of credit, which is usually used with international transitions, where a bank issues a letter, promises to make a loan if conditions are met, guaranteeing payment on shipment of goods if promised. And second, secured loans. For example, accounts receivable financing and inventory loans, meaning a short-term loan to purchase inventory. So that is all that I will be covering, and I'm turning this over to Pete, who will be covering managerial capital budgeting decisions. Thank you.
The cost of capital is the required rate of return that is necessary to determine whether a new project, such as a building, a new business line, or an investment, should is worthwhile and should therefore go on. Typically, this cost of capital is calculated as the weighted average cost of capital, or WACC, and it combines the relative weights and costs of debts, preferred stock, and equity. Here you see the formula. K represents the cost of capital, and we've got the weight and cost of both debt, preferred shares, and equity multiplied together to form the relative value and added together. Next slide. An example given here for A to Z lawn care's cost of capital. We've got the inputs listed on the left. Down at the bottom, you can see that the cost of capital is 6.55%, which means that a project must make 6.55% in order for the firm to proceed. Otherwise, this project would be projected to underperform against the cost of borrowing money, therefore creating a net loss. Firms can use this valuable information to decide whether to proceed in go, no-go meetings. Next slide. So once firms calculate their WACC, they can use the initial capital requirements and projected future cash flows, all discounted at that WACC, to determine whether a firm should proceed with the project. Here you can see that the net present value inputs required are the initial cash flow, cash flows 1, 2, and 3 in this case. So cash flow 0 is negative $35,000 because those are the startup costs required at the initial start of the project. Cash flow 1 and 2 are both $10,000. Cash flow 3 is $25,000. You enter this into the financial calculator, and it yields a net present value of $3,861, which means that the firm is expected to make $3,861 in today's money for this project, which shows an internal rate of return of 11.57, so they should proceed with the project. To choose between multiple projects that could occur at the same time or in overlapping periods of time, managers can estimate the incremental value of overlapping cash flows in today's terms to determine which project to take on. In the previous example, we saw that project A had a net present value of $38.61. If project B, which has similar cash flows but they're slightly different, the initial cash flow, the startup costs are $40,000, represented by cash flow 0. Cash flows 1 and 2 are slightly larger, they're $12,000, and cash flow 3 will be the same, it's $25,000. When you calculate the net present value of project B, it comes out to $2,500. So the firm should conclude that if only one project can be selected, project A should be selected because it has a higher net present value. Next slide. Now, when firms calculate their incremental cash flow information, they can use that to, again, choose between projects, and in some cases, they can, if they have the capital requirements, they could fund both projects at the same time. So in that example, project A in the previous example represented an incremental cash flow of $13.61 if chosen over project B, and that $13.61 is the difference between the net present value of each project. The higher capital requirements in project B could not be made up with higher cash flows. The net present value of project A is greater than the net present value of project B. However, with what we know using net present value, incremental cash flows, and other key information, the team can determine to proceed with both projects if they have the capital requirements to fund both projects simultaneously. And that can be accomplished only because these projects both have a net present value that is greater than 0. So in very rare cases, companies can accept projects that have a negative net present value if the cash flows are such that they can allow the business to continue to pay things like wages and utilities in an economic downturn, even though those projects will generate a net loss. But the cash flows can prove to be more valuable. That concludes our brief, and we thank you very much. Our references are available here.